Welcome to this week's edition of Echo45 Advisors Market and Economic Update. The S&P 500 index recently reached new all-time highs and broke above 5,000 less than 3 years since it crossed the 4,000 mark. While this is positive news and investors should continue to focus on the long run, it's also the case that investors should focus on managing risk and staying diversified. This is because market volatility is inevitable, and how we react to market swings matters just as much as how we position for the long run. In the next few minutes, we'll cover a few key principles when it comes to understanding investment returns and how they impact investor decisions. First, this chart shows the break-even returns needed to recoup a certain loss. For example, a 10% investment loss would require an 11.1% return to make up the difference. For some, this may seem odd at first, but it's just the way that percentages are calculated. For example, if you look at the bars for a 50% loss, a 50% loss means that you've lost half the value of something. So in order to get back to the original full value, you would need a 100% gain. This makes sense intuitively and is also how investment returns operate. The problem is that investors may find it so daunting to have to gain 25, 43, 67, or 100% to recoup their losses. In the worst case, investors may even give up on investing altogether. So it's not only important to manage risk properly so we don't put ourselves in these difficult positions, but also to remember that markets have historically rebounded over long periods of time. Second, it's important to bring up a concept called loss aversion. This is simply the idea that losses feel worse to us than similar gains. For example, if you found a $20 bill on the ground, you'd probably feel quite happy, but if you were to lose the $20 bill from your wallet, or if this were stolen from you, it may feel considerably worse. The gap between how gains feel and losses feel grows as the amount increases. In the extreme, investors may give up on investing when they hit large enough losses. We know this to be true in 2008, again in 2020, and so on. So it's important to stay diversified and have a smoother ride. This chart shows that while the all-stock portfolio would have generated the highest return, very few investors have the stomach for the levels of swings that it experiences. Instead, having a properly diversified portfolio means that long-run returns support financial goals while not causing investors to overreact to short-term events. Finally, the sequence of returns matters as well, specifically whether investors experience good or bad markets first. When investors experience bear markets first, they may be tempted to give up altogether. Additionally, the math of investing works out such that withdrawals from these portfolios don't have the benefit of compound interest, lowering the final portfolio values. Thus, it's critical that investors understand their financial and investment options in this environment. Not only should they put themselves in a position to succeed over years and decades, but they should also understand the withdrawal rates relative to their financial plans. We hope you found these insights helpful. If you'd like to discuss any of this in more detail, please don't hesitate to reach out. We look forward to hearing from you.